Welcome to The Roll Forward, a podcast for the next wave of finance leaders, especially those looking to transform their roles by making smarter, faster, and more profitable business decisions using the power of technology and a forward-looking approach to finance. Listen in to learn how to get out of the back office trenches and become a more strategic partner within your organization.
Hello and welcome to another episode of the Roll Forward podcast. My name is Joe Michalowski, and this episode is brought to you by Mosaic, a strategic finance platform that transforms the way business gets done. And today I am joined by Brad Silicani, Head of Finance and Operations at Anrok, the modern sales tax solution for the internet economy. Brad, thank you so much for joining.
Yeah, thanks for having me, Joe.
Usual podcast spiel before we kind of jump into main topic. Can you give us like the 2-minute background on yourself, the work you do at Anrok, how you got there, all that kind of stuff?
Yeah, happy to. So maybe starting with the start of my professional career here, my background's on the accounting side of things. So I spent the first part of my career with Ernst & Young in audit and technical accounting there. And after about 4 or 5 years, I jumped over to Dropbox and joined the company when they were about 80 people in an accounting role, and spent almost 10 years there in various roles as the corporate controller, the head of tax and treasurer. And ended up leaving about a year ago to join Anrok. And at Anrok, as mentioned, I'm head of finance and operations. But in that role, I get to do much more, include managing our sales team and all the fun parts of the non-finance operations as well. And so I was excited at that opportunity to really grow beyond, professionally the finance organization and learn about other parts of the business. And I've been doing that for about a year here at Anrok.
Nice. I didn't realize that you were at Dropbox before. Did you work? So we've had Ajay on the podcast before. Did you work with Ajay for a while?
Yeah, Ajay was my direct manager for about 8 years. So,
oh my gosh,
spent a lot of time with him.
Just a little bit of time with Ajay once in a while.
Yeah, here and there, we know each other.
Wow, that's awesome. Nice little round out. He was our first guest on the podcast, so cool that we're just going full circle a little bit. So.
Yeah, he was my first introduction to Mosaic too, back when we both were still at Dropbox. He's like, have you heard of this company? Do you know about it? And that's how I first heard about Mosaic.
I should know that. Small world in Silicon Valley and startups, so should have known that something like that would come up. But no, it's awesome. Great to hear about your background. Interesting that there's a connection there. And so before we agreed to get on this, we always ask guests like what their topic of choice might be, and you'd send me a note about talking about like cash optimizations and kind of the state of the economy. So today, main topic is going to be every finance person's favorite topic, and it is cash and cash management. Not going to rehash like the pandemic context. Like, I think it's safe to say the state of the world is a certain type of way, and that leads to uncertainty for the markets, and in turn, people like yourself, people like the people Mosaic sells to. And so can you just talk a little bit about maybe the current market context, like what made you think that was the topic, and like where we're headed in 2022?
Yeah, so I really enjoy this topic. I had a chance to spend about 4 or 5 years as a treasurer at Dropbox and working with Ajay, spending a lot of time to figure out kind of what we needed to do with our cash. And, when I started that journey, it was in an interest rate environment that was very similar to kind of where we are today, which is, zero interest rates. And so not much opportunity to make cash there. Interest rates did tick up a couple of years into that. I think we got up to like 2.25 basis points or 225 basis points there. And then quickly came crashing down in the pandemic. And I think in the environment we are right now, is a particularly exciting time from an interest rate perspective, in that the expectation is that the Federal Reserve is going to be increasing interest rates in a couple of weeks here, and potentially very aggressively due to inflation and other pressures across the economy, which then brings, I think, a really interesting conversation back for the finance organization, which we haven't had to have for the past few years, and even maybe largely the past decade, which is like the opportunity to actually generate, some return with the cash that you have on balance sheet and put that to, help supporting your company. And so I found that, in my journey about learning about this area and managing it for Dropbox, it was one where there's a lot of mystery. You get a lot of advice from a lot of different folks. And so I've really enjoyed trying to navigate that. And that's often like a piece of advice that I've helped share with other finance leaders about my experiences there and kind of what they can do to help think about things and optimize for their businesses. So I think we're at like the precipice of starting that journey again, right? Where depending how fast the Federal Reserve goes here, that opportunity is back. And I think that conversation is really going to come to the forefront for everything from like small startups who, just raised a few $1 million all the way to your large public companies, right? Who have maybe hundreds of millions or billions on the balance sheet.
Well, so that's what I wanted to add, because this is I've learned a lot about finance just from writing content for Mosaic and talking to people like you. This is not a topic that has come up in my conversations, so I'm excited to learn more about it. But the thing that I want to start with, because I don't understand it myself, is how does this impact like a earlier stage like VC backed startup? Like they're not generating tons of revenue, like they're not generating a profit, so they don't have money to go invest to like take advantage of these things. How does this conversation work for those companies versus like a Dropbox that obviously has a lot of cash and a lot of business coming in and out? So yeah, I'd love like some more context about how that works.
Yeah, I think as you highlighted, it's definitely a spectrum of kind of what you're going to think about and how you're going to approach this challenge. I think starting on like the small end, if you're a company that just raised a few $1,000,000 or tens of millions of dollars, you're going to have cash in the bank. And yes, you're in a situation where you're in a cash burn, right? Each month, your expenses are going to likely be higher than your revenue. But the opportunity still exists there for the cash that you have raised to make some very I would recommend, low risk investments here into like government type securities where you can generate a return on your cash. And so that return, maybe a couple $1,000. I think as interest rates start ticking up, there's tens of thousands and hundreds of thousands of dollars opportunity here, even with maybe $10 million of cash there. And yeah, that's not going to be something that is going to, make the biggest differentiator in your business, but it's also a headcount, right? You can pay for another FTE, you can pay for that holiday party. And it's something that like finance is uniquely situated to be the only organization within a company that can just like directly put cash back into the business, right? Without actually selling to a customer. So, you think about that, and then also think about the backdrop of the inflationary pressures that are happening right now, where like if inflation continues to increase, prices go up, just letting cash sit in your bank and not earning any interest on that is actually in theory losing money in terms of your spending power. So putting that to work and generating a little bit of interest income can help you keep up with that inflationary pressure as well. And then you take that to like, the large organization on a public company like Dropbox or beyond, you have a whole host of investment options and different approaches that you might be thinking about and how to really optimize that capital.
Gotcha. So obviously your background, Treasury. I want to know more about like whose responsibility this is and how that does evolve. So, a startup that just raised like a Series A, like they're probably, or I'll go as far as say definitely not going to have like a dedicated Treasury person or a Treasury department. And so are companies thinking of like bringing that function on earlier now because of, the up and down of the market? Or if not, like who is responsible for that in the earlier stages, and like how does that evolve as the company scales?
Yeah, it's a great question. I would say that like in general, companies are not going to think about a treasurer until like an IPO, maybe a little bit before it, and even maybe well after it. It largely depends on like what the cash flow of their business looks like. So this conversation becomes even more interesting because the responsibilities here fall to a finance organization who does not have necessarily an expertise in treasury. So, from that Series A company, that could be maybe even the founder who's kind of running the finance organization. That could be a VP finance. It could be a controller, right? I think largely this ends up falling as you get into it in a controllership and accounting organization, something that they may touch because they are managing, reconciling bank accounts and things like that. But it could be easily within a VP finance scope as well. And so the opportunity for them is there, but in my personal experience and journey, like coming from being an accountant and then becoming a treasurer, I took responsibility for these things when I was the controller at Dropbox.
Right.
And so I had to like educate myself, and that's where I think I had a lot of exciting conversations with folks about just trying to educate them on kind of what are the small levers out there that you can pull to be able to help support your business. And then eventually you can hand this off to a treasury organization. Things go well, and they can do a deeper dive here.
Yeah, I love what you're saying about kind of helping educate people, because that's exactly what we're here for. And so I want to get to strategies like in a little bit and maybe some like tips. But first, kind of piggybacking off this idea of like what the context is like as companies scale, I'm curious if there's like a handful of, mistakes that companies make as they navigate like kind of uncertainty in the markets. You mentioned a mistake might be just leaving your money in the bank as interest rates go up. It's like, you're not technically losing money, but you're missing out on earning more money. So are there any things you've noticed, maybe things you've learned over the years that are mistakes as people kind of navigate this?
Yeah, I mean, definitely you could argue it, and I gave the example of like leaving money alone and not earning interest there could be a mistake. I think it's a good mistake though. Like I think here, the bad mistake that, people can make is going too far in terms of what they want to do for investments. And so sometimes I talk to folks and they're like, should I take my money? Should we put it in cryptocurrencies? Should we put it in equity securities? Should we put it in, long duration things? Because, the return is going to be much higher as you think about the risk trade-offs and duration of those types of assets. Sure. But I think the core principle to remember as you think about managing cash for your business is that your investors gave you money because they thought that you could make a really good product as a company. And that's what they invested in. Like if they wanted to go invest in Bitcoin, they could directly go do that themselves. They could do that on equities as well. So I think the mistake here is like going too far and finding some of those yields to be really attractive, particularly when like the market's going up, up, and up. That's an easy trap to fall in. And really, you got to stay like principled to like, I'm here to like preserve capital and just make a little bit of return so that, the business can focus in on placing big bets on, building our product and winning there. So I think to recap, the mistake is just going too far. And it's actually an okay mistake to do nothing, right? Yes, you like in theory have lost money, but you have not in fact lost money, which is the part where you'll get in real trouble with your board if something goes wrong.
It makes total sense. Personally, I'm pretty risk averse. So if I were in this position, I think I'd be very happy just to keep my millions of dollars and keep on building my business. But I like this idea of like striking a balance and, making sure that you keep in mind that you're there to build a product, you're there to get to market. And so this is just a way to kind of kick your cash in the right direction to help you do that. Conversely, so we're talking about the market going up and up and this being like a particularly exciting time for finance and treasury people. It might not stay this way forever. So in the coming, months, years, whatever, if things start ticking down again, what is a mistake that might have happened like in recent years or something you've noticed where, there are 0% interest rates and you can't do it? Like what's something that might trip someone up in that situation?
Yeah. So in narrowing that, I think, the focus for corporate investing should really be on debt securities, right? And debt securities mean that you're going to earn a return based on the interest that is there. So separate from the equity markets, which are coming down now, we expect the interest rate markets to be going up there. And so, as you think about interest rates going up, if the expectation is that they're going to continue to go up, say over the next 12 to 24 months, you want to be a little bit careful on the duration that you select for your debt investments. Because if you selected a 1 to 2 year duration now, and that's at maybe 25 basis points, you're going to be locked in on that investment and miss out when, interest rates get moved up to 200 basis points, maybe in 18 to 24 months. So I think that's a mistake that you got to just keep an eye on where are we going? Are we going up on interest rates? And then if you're coming back down, also consider how your cash is turning over there, right? Because every new dollar you're going to be able to invest is likely going to be at a lower return if the interest rate trajectory here is coming down. So being able to hold on to some of those longer duration ones might actually be a good strategy if you see interest rates coming back down as well.
Gotcha. Yeah, this is the kind of conversation that I like. I do content, I write for a living, and there's a lot of gray area, and it just sounds like this is very much the same, where there's no hard and fast rule, like this is what's happening, do X, Y, and Z. Like you have so many options, and it's really up to someone in finance to have that sort of strategic mindset, or if they're a dedicated treasury person. This is very much strategic growth oriented, and it's just cool to hear you kind of think through how to make that work for an organization. And so I want to roll this into sort of a meatier topic, which I'm not really sure what this looks like. I know I want to talk about strategies. What are a handful of strategies somebody can do to optimize their cash in a market like this one. And I don't know if this is something that has a list of 5 things. It's here's strategy number 1 with a real name. So I'm curious to hear you just talk about if you had a handful of strategies, what would they be called? What do they do? What's the overview there?
Yeah, and maybe I'll talk about that in very practical or tactical terms about just what somebody could do to get started here. So I think the first thing that I would recommend for a business in thinking about getting started on investing is investing in what's called money market funds. So those are highly liquid investments, meaning that you can get your cash out at any time, which aligns with that principle here of preserving cash and being able to use it for your business. And it's also really high quality. So within money market funds, your options here are government money market funds, which are backed by the U.S. government, and then prime money market funds, which are backed by corporations. And so I think a really good strategy for folks to put into play is to establish a money market fund investment portfolio. And in doing that, there's some good tools out there with the banks where you can have access to a lot of different fund families. So a fund family is like, think about each bank maybe has 4 or 5 different types of money market funds. You want access to a bunch of different banks to be able to pick and choose who's giving you the best return. And a lot of banks will offer a money market fund, but to quickly move your cash over to, but it's likely going to be a very limited set of options. So finding a good platform where you can invest in a multitude of money market funds is something that I find a really good and effective initial strategy. And here I would start employing the strategy, maybe if you had $5 million of excess cash or more. Right. At that point, it's probably good use of time in terms of the interest income you're able to generate for the amount of effort it's going to take to put it in place. And that's assuming, the Fed makes this interest rate move here in a couple of weeks. Right. So there is something to be made. And that's a strategy that is a good step one for a lot of companies, and one that continues all the way through to public companies. So even at the large public company level, they're still going to have this type of strategy. Instead of this applying at the small end for all of your money, at the large end, this is going to apply just to a set of tier of your money, which you need pretty quick access to. The next strategy to think about from there is about increasing on duration, so the length of time that investment is going to be outstanding, while still keeping risk in the right place. And so there, the strategy that I like to put in play or would recommend is thinking about some external investment advisors. And so typically this is called a separately managed account strategy. And here in this strategy, what you're going to do is you're going to take a portion of your money and you're going to hire a third-party investing firm to be able to actually make decisions about which specific assets they're going to invest in. So here on the money market fund side of things, you're investing in a fund, which then invests in a basket of assets. On the separately managed account side of things, you're investing directly in those assets. And again, you can choose the government route or the corporate route or a blend of the two. And you're given directions to this third party to be able to invest on your behalf. That is a strategy which produces significantly higher yield. I would say if you want, this is going to vary in terms of, times in the market, but this is going to be like 4 to 5x the amount of return that you're able to make from that money market fund strategy. And here you're going to say, hey, maybe I want like a 1-year average duration. I'm going to place 10 million, 50, 100 million, depending, what your balance sheet looks like. And those advisors are going to invest on your behalf and you're going to earn that return. I would say I wouldn't get to step 2 until I had a pretty high degree of confidence that I would not need that cash that I'm going to allocate to this strategy for at least, like 12 to 18 month duration. Right. So if my business is burning really quickly and I'm kind of always going back to equity raise, this is probably not a strategy I'm going to take. If my business is pretty stable or I've raised a large amount of capital from my last round, then this is a strategy that I would really consider pulling the lever on. And there, to quantify that, I think that you probably want to think about $10 to $50 million as like the range of money you'd want to allocate there. And then the other thing I'll say about the separately managed account piece is that you probably want to do that with a couple different advisors. So having 2 different advisors or investors in there really helps you then decipher performance, right? And is it investment advisor 1 performing as well as investment advisor 2, and making sure that they're competing to really get that good return. And I would say, for the startup through initial public company, those are going to be the strategies that you would consider. There are strategies beyond that where you take some of that, in-house and start doing self-directed investments. But again, pairing that up with when you're going to bring in a treasury team, I would not recommend doing that, until much later in maturity of your company's life cycle, because your team probably just doesn't have the expertise on how to pick those investments where you can outsource that to those third parties.
Yeah, even just hearing you talk about it, it's this is absolutely somebody's full-time job. This is not something we just step in on for a couple minutes and we're yeah, we'll throw some money over there and we'll see what happens. So really appreciate the tactical breakdown. Every time I do one of these conversations, and so you and someone like Ajay and Temi who we mentioned earlier, I'm always very impressed by how you all are able to break something down for someone like me to understand. And I think it's why anyone comes on and appreciates listening to these episodes, because it's what you guys do all day, is go around to other departments and talk to people who don't know finance and tell them about finance related topics. So really appreciate that breakdown. Very easy for me to understand, which is not an investment guy, so
there we go.
So it sounds to me when I think cash flow, if you're looking at a cash flow statement or a balance sheet, there's obviously a very simple version where like if you keep everything in one bank, like there's not that much going on in terms of like where your money's coming in, where's it going out. The more investment sort of strategies you put in place, I'm guessing the more complicated like your financial statements become and the harder it gets to maintain visibility into your cash flow. How do you handle that? Like, what are the challenges of like just keeping an eye on all of this, especially as, you know, you're Anrok now, it's just you, like you don't have a whole team, you don't have a whole treasury department. Like what challenges do you face in just keeping visibility of all the things that are going on?
Yeah, I think, as the business grows, complexity definitely increases and becomes more and more of a challenge. And you're going to want to think about tools out there to manage cash flow. So again, if we go like to the end point, a public company, there's things called treasury management systems and workstations that do like detailed analysis, but you're not going to want that until much later in your life cycle. For where we are here at Anrok, I think, and for, I would say, if you think about going through even, late, Series E and F companies, this is something where you want to, or I like to take a risk approach that like, hey, we don't have a fully dedicated resource to this, and we don't want to take on that complexity. So make sure that the amount that you're allocating to these investment strategies gives you plenty of buffer to not have to look at it on a like daily or weekly basis. So I like to think about like, let's have 3 to 6 months of cash in just a checking account, which like we're not going to have a hiccup in the business where someone's going to come ask me for money or we need to make a payment and I'm going to even need to think about the investments. So I think just tiering that out and thinking about it that way helps reduce a little bit of that like ongoing complexity to keep an eye on what's going on. And then I like to do at least a quarterly, block up my calendar of just like, hey, let's go through each quarter, take a look at what we did put in these investments. How are they performing? And like, do we want to make any changes? And that's part to like, one, have a good eye and control on it. But two, also to like not actively invest here, right? The goal is like passive investing. And so you don't want to be on a daily basis seeing the latest news from what's going on in the world and reacting to that and like changing what's happening in your investment portfolio. You want to like have a strategy which you're comfortable letting ride for the long term. So that quarterly check-in is a good way to help focus and understand what's going on there as well, while not being like too active on the investment approach here. Because again, your goal for the business is to like protect cash, not to, turn an outside return there.
Yeah, not turning the finance team into day traders that are just moonlighting as people who, do some planning here and there and whatever else. Yeah. So
prudent totally stewards of the capital.
Yeah, stewards of capital, that comes up all the time, and I'm a big fan of that term. I don't know why, it just really, really sticks with me. It comes up in most of these conversations, and I'm glad that the finance community really takes that job seriously, and it's really interesting to hear you kind of balance like maintaining that while, putting these investments to work. And so one thing that I'm not entirely sure is related, I know it came up in your message when you mentioned like wanting to talk about this, and it's like how tax plays into this, and I know it's what you all do at Anrok, and so I'm curious if there's like a way you can approach your taxes to facilitate some of this cash optimization. Does it play into the investment side at all? Is it like a way you can free up some extra money to invest? Like how does tax play into this, and is there any tip you have to sort of manage taxes that would then help out this conversation we're having?
Yeah, it's a great question. And I think like overall, the relationship between tax and treasury is a really tight one. You'll see often in larger organizations that they're even a combined organization. And I mean, I think the second part of this is like tax is a very broad term as well, right? There's lots of different types of taxes. So you're going to want to think about income taxes as you generate some of those returns. You're going to want to think about, sales taxes and other types of taxes as you think about managing your cash flow. And so, I think a practical tie-in for the small to medium size tech company here is thinking about how your cash flows as a business impact the amount of cash that's in your bank account. So a couple of examples here would be the longer that you allow your customers to have credit terms to pay you, the less cash you have in your account and the less cash you're earning a return on. Conversely, the faster that you're paying out money, the less money you have in your account and the smaller amount of interest income you're able to generate. So as you start to think about the like major categories of cash flows in your business, clearly revenue is going to be a large one. And along with that, is sales tax, right? Where sales tax can be, 7, 9, 10% of a sale. And that's money that's going to be coming onto your balance sheet and then out eventually when you go to file and pay that sales tax return. So any opportunities and abilities you have to kind of monetize on that flow, will help you improve the amount of interest income you're able to generate for your business. And then you also want to think about that on the outflow side of things. So thinking about like how and when you're going to pay bills and making sure to optimize that can also help you really improve, what your cash flow situation looks like, and conversely, the amount of capital you have to invest and make that return.
Sure. Cool. Love all that. Again, not a tax guy. So I get my tax returns out every year, and that's the extent of my knowledge. So again, really interesting to hear you kind of break that down. I think people listening will really appreciate some of the insight you gave. One question I had, and you mentioned earlier in the form of like a treasury management system. But aside from that, like, are there tools that people can look at? Is there like some part of the tech stack that is particularly relevant for all the things that we've talked about so far? Like, is there something someone can put in place, or is it more of just, interactions with the banks? I know you mentioned like the tools that banks offer to manage different investments. Like, is there anything on the market that someone can look at and say, I'll add that to my tech stack and it'll make my life easier on this front?
Yeah, it's a good question. And I think one that, again, has like a range of outcomes here. I think the biggest challenge on managing your cash is just knowing where it exists. And so as you continue to grow your business, you will likely continue to grow your banking relationships. And that'll happen just by, one, staying domestically. You are likely to add in a couple of different banks as you think about needs across debt and equity. And that will happen as you go internationally. And you may need a bank that has international or more robust international capabilities or specific capabilities in a jurisdiction you're looking at. Then you start adding in the money market fund strategy and the other things we talked about, and you end up in the situation where cash is like in a bunch of different locations. And I think the biggest challenge is just trying to bring those things together. The Treasury workstation on the high end is a solution to try to integrate all of those things. I think on the smaller to medium size end, it's really focusing as you select your banking partners. Do that have the ability to integrate into your GL, or is there another tool where you can integrate that bank statement and banking information in one place so you can get that consolidated picture of cash? Because as simple as it seems about like knowing where your cash is, the situation becomes pretty difficult quickly because each bank is going to have like a different reporting type, a different reporting frequency, and you end up like spending a lot of time to consolidate those things. So, I think being conscious about, what types of integrations those banks can offer natively to the systems that you have or other pieces of your fintech stack is really important. So you don't end up in a situation where, things are isolated off the side and, you maybe only be focused in on 75 million out of your $100 million pie because, 25 of it is often this other system that, can't integrate or you can't bring that information easily into your system. So I think, given all the different pieces of a tech stack there, like thinking about how it integrates to the GL early is a helpful one. And then as you continue to mature, you can think about other tools like a Treasury workstation as a kind of post-public life as well.
Gotcha. Yeah, I mean, pretty much all of our content talks about some sort of siloed tech stack, disconnected systems. Like it is no matter who I talk to and what the topic is, it's like, hey, what are the challenges? And that always seems to be finance's thorn in the side. And so, like I said, this is a new topic for the podcast, something we haven't talked about like in any Mosaic content. Not totally shocking to me that this boils down to like there's a lot of different systems, there's a lot of different areas that things are at, and like you got to bring it all together, you got to have visibility. So, not shocking.
Yeah, it's the core to answering what's going on with your business, right? And cash is so fundamental. You got to solve that problem to make sure you're effective.
Absolutely. So we've been talking for a bit, and I don't want to take up too much of your time. There is a question we ask every single person that comes on. Selfishly, I say this every time. My favorite question, because it kind of zooms out from a lot of the tactical stuff that we've been talking about and gets some insight into careers and things like that. And so I will ask it to you, as I do for everyone. What is one thing that you know now that you wish you knew back when you started your finance career?
Yeah, that's a good question. For me, I think maybe it would kind of mirror what my career arc has been, which is, very early on when I started my career, as I mentioned, I was at Ernst & Young in accounting, and I was very focused on doing everything and learning everything that an accountant needed to do, right? And I was in an environment where I was completely surrounded by accountants. And when I went to Dropbox, I think in my first like couple of weeks there, it was this like big shock that some of the things that I took for granted in terms of the terminology I used, the perspective I took on things, the way I wrote even emails or communicated to people did not resonate with the rest of the company. And it was that first time that I had worked with engineers and people in sales and all these people who just weren't in an accounting background. And I roll forward that experience to where I am now, where I manage a sales organization, manage lots of things outside of finance. And my advice to myself back then would be like early and often and continually through your career, try to not be a finance person. And that doesn't mean that you have to like take a role that's outside of the finance organization. It's about putting yourself in the position of the people that you're trying to communicate with and taking the perspective of what is the salesperson going to think about, the communication and priorities that I want them as a finance person to have. What is the engineer going to think as I go to present them with this new tech, solution or something that I need implemented, right? And being able to put yourself in their position to understand and empathize with their needs and communicate in ways that are going to resonate with them will make you tremendously more successful as a finance person to then be able to bring that finance message to those people and have them engage and understand and appreciate what your objectives and goals are. So I think, trying not to be a finance person, whether that's, trying a role outside of finance or even just putting yourself in that role where you can empathize and communicate with others is super critical, in my opinion, to making a really strong finance organization. And I'll give Ajay credit. I think he did a great job of that in our time there at Dropbox. And so, yeah, it's something I like to tell finance folks to try as they continue in their career.
I love it. You're absolutely right. I think Ajay, if I go back and listen to the first episode, I feel like he'll probably have a similar answer. And it is definitely something I can see a very similar skill set in you. I mentioned earlier, just like this ability to talk to someone like me and explain all these things in terms that everybody can understand, not just like throwing spreadsheets at people and saying like, hey, here are the numbers, like go figure it out. And so, yeah, I think you're spot on and absolutely something that you can tell has like the Ajay influence a little bit there. I don't ever do this, but I want to zoom back in for a moment. Do you have like one tip for, so this comes up a lot, like being able to collaborate. Do you have like a more tactical tip to actually making that more empathetic side of finance like part of your daily job? Like, is there something you do that makes that easier, or is it just like conversations with people? Like, what can people do?
Yeah, it's a great question, and you kind of teed it up, but I do think it's conversation and relationships. Yeah. Like, I think that in finance, we often think of like a very tactical set of things that have to happen. We need to close the books. We need to produce a forecast. We need to process the bills. We need to do those things. Yeah. And without a doubt, those are like super critical parts of the role. And maybe this is more advice for me as a younger professional, which is like, those things are important, but like the relationships that you have are going to carry you even further than that, right? Carry you beyond being the like tactical person who can accomplish those to the leader who can like push those things forward. And so I think that investing in relationships is super critical to success. So being able to have that, one-on-one and coffee chat and picking the people who are just not clearly part of your normal workflow will be the most valuable relationships. So don't pick those people who like, okay, this is the salesperson who I give the sales report to, and I'm going to naturally talk to them, or this is the IT or engineering person that I need to like help set up my GL. Find that person in your company and in your broader organization who you don't have that natural relationship with in terms of your workflow. And that's the type of relationship where you can engage and understand what they need, because there'll be no, transactional purpose to that relationship. So you can really get to the essence of understanding from them, like what's important to them, why do they prioritize it, how, can you land messages best with them. Which will help you tune those other relationships really effectively. And then also you'll come across a situation where it's like, we came across a problem we didn't expect, and now I have that relationship where I can, really save my organization or save what's going on by leveraging that relationship that I've spent the time to build and invest in, and now can come to fruition to help everybody win here. I do think it's a lot of relationship based and getting away from tasks that the finance organization needs to focus on to the relationships.
Yeah, that non-transactional relationship feels like the crux of it. And, I get a lot of value out of that from my job. And so can definitely see how that would benefit anyone in finance too. And I like this ending on this question because it kind of zooms us out, like I said, and I think it's a good place to kind of start wrapping things up. I love this idea. The tip is great. So anyone listening, find somebody in the org today or tomorrow, go talk to somebody that you have no transactional relationship with, and see where it takes you. But yeah, so Brad, I just want to say thanks again for joining, but this is your time to shine. Where can people go to learn more about you and Anrok? Anything you want to plug, it's all yours.
All right, great. I didn't know I have the plugging opportunity here, but yeah, if you want to find out more about me, feel free to shoot me a note on LinkedIn. I'm happy to connect and chat with folks about anything across what we talked about here, or if I can share other parts of my experience there at Dropbox. On the Anrok front, Joe, you did a nice introduction at the beginning. What we do is we have a sales tax platform that helps support SaaS businesses really identify when and where they need to comply with sales tax, which hint the answer is there early in your life cycle, and then deal with the burden of that ongoing compliance by helping them execute on tax calculations, returns, and filing. So if any folks out there need help on that front as well, please check us out at anrok.com, and you'll be happy to have a conversation there, see how we can help support you.
Awesome. Well, Brad, thank you again for joining. This is a really great conversation. I think people are really going to like all the advice you gave. Just appreciate you spending time, and thanks again for joining the Roll Forward.
Yeah, thank you. Appreciate you having me, and enjoyed the conversation here today.
Thank you for checking out this episode of The Roll Forward. This show is powered by Mosaic, a strategic finance platform that transforms the way business gets done. If you enjoyed what you learned in this episode, make sure to follow The Roll Forward wherever you listen to your favorite podcasts. Or visit mosaic.tech/podcast to get immediate access to all of the latest episodes.